Hello everyone, and welcome to today's episode when we are going to discover what is institutional calendar, also known as rebalancing windows. You might have noticed that every now and then market might behave somewhat irrational in terms of buying or selling pressure towards certain assets, which are not aligned with price action or major economical events. This is exactly what we are going to talk about. Imagine that those major price movements are essentially created by pension funds, mutual funds, designated day funds, essentially responsible for 401ks or RSP accounts. In a number of cases, those entities operate largely somewhat irrational, but understanding their calendar and their moves is very important in order to improve your investing strategy. So this is what we're going to cover today. And before you're gonna go on and say that pension funds, mutual funds, this is so boring, let me give you a little bit of context and understanding why it is important. The total US equities market is lending somewhere between 52 to 55 trillion of dollars, whereas the total US bonds market is at large around 48 to 50 trillion dollars. Now, you can imagine the importance of the pension funds, taking into consideration that the total capitalization of pension funds is 45 to 48 trillion dollars, which lands them essentially on 42 to 45% of a total US equity plus bonds market. If you think of the size and capitalization of mutual funds market, that would be 17 to 18 trillion. Index funds are 30 to 35 trillion dollars in total capitalization, which is very substantial. And the designated day funds capitalization of 4.8 to 5 trillion dollars. That's why in the case you are mainly focusing on long position, which means that you buy certain equities and you hold them hoping that they're going to go up in value and benefit from dividends. These are the guys you need to pay attention to. Let's discuss how they manage their money and their calendar. Pension funds do end of month and quarterly rebalancing, which means that end of every month, last 3 to 5 business days, this is when essentially they are selling the best performing equities and buying bonds. Reason for such irrational behavior is that pension funds essentially operate on a designated asset allocation schedule, which means at large that they would need to keep somewhere approximately 60% equities and 40% bonds, regardless of a price action. Quarterly rebalancing that are substantially, in a number of cases, has much higher volume. So every third Friday of the month ending the quarter, such as March, June, September, and December, they would do a big rebalancing. When again, you can see a spike in selling pressure. Then moving on to indices. Indices do rebalancing end of every quarter, and their schedule at large aligns with the pension funds rebalancing, which means that again every third Friday on the months of ending the quarter, March, June, September and December, index funds would need to buy new additions to the index and remove those companies that are out or have been merged or acquired by the other ones. Mutual funds would need to rebalance quarterly and end of year, pretty much trying to hide their losers or positions that not delivered a desired results by the shareholders to begin with, or overall did not capture the market performance, such as, for example, some mutual funds might have purchased second-class miners, hoping that they will deliver an incredible returns, and in the case they did not, whereas, for example, on the market everyone is only talking about Nvidia, that's what the mutual funds will be purchasing end of quarter and end of year to show approach and trendy approach in a number of cases to the shareholders. Then we have target date funds. These are funds managing your 401ks, RRSPs, and so on and so forth. So essentially they need to provide extra returns by a specified date, which means they will have to sell best performing equities and buy bonds or purely convert into cash so they can distribute that liquidity towards the shareholders. Essentially, people who need to do withdrawals for their pension. Speaking of assets under management volume, I would love to share with you that, funny enough, having an equity market of a certain size, the options market for the same equity market is essentially coming at a multiplier of 1.1 to 1.5, which also translates into the fact that for every unit of equity we trade 10 to 50% more options, which is a fairly recent phenomenon, largely started last year with a spike of 0-day to expiration options, active trading in retail investors segment, and income ETFs. So to summarize the behavior of the key volume creating players on the market, we can define that pension funds are selling what went up end of every month, last 3 to 5 business days, and end of quarter on the third Friday in March, September, June, and December. Index funds would buy what has been added and sell what went out end of quarter. Mutual funds will hide the losers, and hedge funds will the risk and the leverage in the case the situation would present itself. So the next time when you're considering to buy equities, let's say end of the month, and you see a selling pressure, some good chances are that this pressure is created by the pension funds. On the other hand, if you are considering to operate with options and the hedge funds on the market are actively de-risking, it can create a contrarian wave towards your trade without any major underlying substantial reasons. Overall, I would like to summarize that pension funds, mutual funds, target date funds, and the indices operate at large long positions in equities and bonds, whereas investment banks and hedge funds would have impact on the options market, where essentially hedge funds would act as a key catalyst, whereas investment banks, they would act as a house. I hope you found this video informative and educational. Thank you so much for watching, and I will see you the next time.